Welcome back to The Deep Dive. Today, we are taking a deep breath and cracking open the Q3 2025 earnings call for AMC Networks, ticker AMCX.
And this isn't just your standard report.
No, not at all. This is really a progress check on one of the most difficult transformations happening in media right now.
It is. You have a company that's trying to defend its legacy cable business while, sprinting to become this tech-focused content house.
And that tension, that's the entire story of this quarter.
It's the ultimate balancing act. So our mission for you today is to cut through all the noise of the presentation, and believe me, there was noise, to give you the critical insights you need on this big structural shift.
Right. We need to figure out if the wins on the digital side are big enough and efficient enough to manage the accelerating decline of that traditional business.
That's the question.
Okay, let's unpack this. Let's jump straight into the headlines because the market really didn't know what to do with these numbers.
Not at all.
It was a super volatile day. The stock was whipping around before it, ultimately closed up about 3.7% on pretty high volume, too.
And that's because the immediate headlines were so mixed.
Mixed is a very diplomatic way of putting it.
Well, let's look at the snapshot. Consolidated revenue came in at $562 million.
Which is a good beat, right?
It was a good beat. It topped the consensus by about 2.3%. But, and this is the big but, you have to remember that's still a 6.3% decline year over year.
That's the linear business shrinking baked right in.
Inevitably.
So a revenue beat, despite the decline, that's good. But then we get to the bottom line, and that's where things immediately got confusing.
They really did, because you had two profitability numbers telling two very, very different stories.
Okay, so first, the GAAP EPS number.
Right, the generally accepted accounting principles number. That looked phenomenal. $1.38, a massive beat.
But management themselves kind of poured cold water on that one.
They did. They were quick to point out that figure was driven by non-recurring items and below-the-line adjustments.
Okay, let's pause there. Quick clarity check for everyone. When they say below-the-line adjustments, what are we talking about, practically speaking?
Good question. In this context, it usually means things like, one-time tax benefits, maybe the sale of some non-core assets, or often, and this is the big one, non-cash impairments related to restructuring.
So one-time events that make the net income look good but don't really reflect the core health of the company?
Exactly. They're not repeatable. That's why the market pretty much just tossed that number aside.
Understood. So the number investors really focused on was the adjusted EPS, the one that strips all that stuff out. And that number was, it was brutal.
It was. The adjusted EPS came in at just 18 cents.
18 cents. That missed the consensus of 31 cents by 42%?
A stinging 42%. And even more critically, it represents a sharp 80% decline from the 91 cents they delivered in Q3 of last year.
Wow, 80%.
That margin compression, that's the brutal operating environment we're talking about. The consolidated adjusted operating income also fell 28%.
So this is where that tension is impossible to ignore. They beat on revenue, great, but they are taking massive pain on the bottom line to do it.
Exactly.
So let's drill down into the domestic operations. This is where the pivot really lives. Where is the business shrinking versus where are they actually getting that strategic growth?
Okay, so you have to acknowledge the depth of the legacy headwinds. Domestic revenue was down 8.4% year over year overall.
Oh.
Now, subscription revenue, that's mostly affiliate fees from cable companies, it managed to hold flat at $316 million.
Which is actually a win in a weird way.
It's a huge structural win. Holding those fees flat when the cable universe is still shrinking, that's stabilization. It's not growth, but it's a win.
But the real damage, the real pain, that came from the advertising side, didn't it?
Absolutely. The high margin money is just disappearing. And fast. U.S. advertising sales fell a punishing 17.4% to just $110 million.
When you lose almost a fifth of your ad revenue in a year, that's a massive drag on everything.
A huge structural drag. And on top of that, you had content licensing, the deals where they sell shows to other partners.
That suffered too.
Yeah. It dropped 26.7% to $59.4 million. Now, management tried to blame timing and delivery schedules.
Sure, they always do.
But a double-digit decline just adds to the story that the whole legacy ecosystem is under severe pressure.
Okay, but this is where it gets really interesting. Because the offset, the other side of the scale, is finally becoming tangible.
This is the inflection point, as the CEO called it.
Right. Kristen Dolan called it a key milestone, the moment they've been waiting for.
And that inflection point is just undeniable in the numbers. Streaming revenue grew 14% year over year.
To what, about $174 million?
Approximately, yeah. And even though their total streaming subscribers only grew about 2% to 10.4 million, it's the revenue trajectory that really matters here.
I am stunned by this next figure. Streaming revenue is now on track to become AMC's largest single domestic revenue source for the first time ever in 2025.
That's the entire story in one sentence.
It is.
Streaming revenue is now outpacing those stable but shrinking cable fees. The company has officially shifted from being a cable network that also streams to a streaming service that happens to also own cable networks.
That's a massive internal shift, even if the sub numbers look small compared to, a Netflix.
Right. Their strategy isn't about competing on global scale. It's about efficient, targeted delivery, and a lot of that is through these complex wholesale deals.
Which brings us right to their operational shift, because you can't understand that 14% revenue growth without looking at the distribution deals.
They're basically externalizing their customer acquisition costs, their CAC. They're letting partners who already have massive platforms do the heavy lifting.
And the DirecTV deal in Q3 was a perfect example of this.
A massive distribution win. It's a renewed long-term deal where DirecTV now hard bundles the ad-supported version of AMC Plus and 6 of their FAST channels into video packages.
Okay, for anyone listening who isn't deep in media jargon, can you just quickly explain what FAST channels are?
Absolutely. FAST stands for Free Ad-Supported Streaming TV. So think of them like traditional TV channels, but they live inside a streaming app.
Like Pluto TV or something.
Exactly. And they generate pure ad revenue. So by bundling AMC Plus and these 6 FAST channels with DirecTV, they immediately get massive, stable reach without spending a dime on Facebook ads to get a new customer.
They're just leveraging an existing customer base. It makes perfect sense. But they're not shying away from licensing deals either.
No, that's still crucial. They expanded their Netflix deal, giving them international rights for big franchises like the Anne Rice universe, Dark Winds, and of course, The Walking Dead.
But maybe the most sophisticated move was that new bundle on Amazon.
I think so. The AMC Plus, MGM Plus OO, and Starz triple bundle on Amazon Prime Video channels. That signals a massive push into third-party aggregation.
Why is that specific bundle so important strategically?
Because Amazon is handling everything. The billing, the customer service, the marketing, for 3 mid-sized streamers who all kind of lack the scale of the top tier.
But together, they're a compelling offer.
Smart collaboration. And you also have the ongoing success with Charter Spectrum. Over 850,000 customers have opted into the ad-supported AMC Plus through their TV package. Again, stable revenue, zero SHA.
Okay, this is all great, but none of it works without killer content and a cost structure that can actually support it.
Right.
Especially with that 80% EPS margin pressure we talked about. So let's turn to the content pipeline.
Their whole strategy is about maximizing the lifespan of their IP. It's about having programming do double duty.
Let's clarify that term, double duty. We hear it a lot, but what does it mean for AMCX specifically?
It means they produce the content once, but then they cycle it through multiple revenue streams.
Okay.
So they'll run a new series like the Anne Rice shows on the linear cable network first. That gets them affiliate fees and linear ad dollars. Then it quickly moves to AMC Plus for the premium subscribers.
And then after that?
After a defined window, they can license it internationally to someone like Netflix.
Yeah.
You produce it once, you sell it 3 times. It's the ultimate cost efficiency model for a player their size.
And it paid off this quarter with that new Anne Rice series, Talamasca. It premiered to 2 million viewers across all platforms. That's a huge number to point to.
It is, and they're still investing in quality.
Yeah.
They finished production on the Audacity, which has writers from Better Call Saul and Succession. And operationally, they are getting leaner.
The buyout program.
Right, a voluntary buyout.
Yeah.
It was a small reduction, less than 5% of their employee base, but it was specifically focused on getting rid of legacy roles and investing in digital skill sets.
That's all part of the pivot.
The pivot requires a new kind of workforce.
Okay, this all leads us perfectly to the capital structure, because the real reason the stock recovered after that brutal EPS miss was management's singular focus on one thing: free cash flow, FCF.
Absolutely. They reiterated an increased full-year FCF outlook of $250 million. That's their North Star right now. They're explicitly saying they'll prioritize cash generation over margin volatility during this transition.
Hold on, I need to challenge that. You just said they missed adjusted EPS by 42% and the margin is collapsing by 80%. So why should investors care about a free cash flow target that feels so disconnected from profitability? Isn't the margin collapse proof that the model is failing?
That is the central critical question. And the reason they prioritize FCF is simple. Cash is king during a transformation. They need that cash to fund their content slate and critically, to stabilize the balance sheet. They are willing to accept the temporary paper pain of adjusted EPS compression because the FCF is the actual tangible cash they can use to pay down debt and fund the future.
So the argument is if we have $250 million in FCF, we can survive this. To put that in perspective, how close are they to hitting that target?
They're very close. They generated $232 million in FCF in just the first 9 months, so getting to $250 million looks highly probable.
And they're using that cash discipline to aggressively clean up the balance sheet.
All year. They prepaid the remaining $90 million on a term loan. They extended $111 million of revolver commitments all the way out to 2030. They even repurchased some of their own debt at a discount, buying it back at 84 cents on the dollar.
These are financial moves that just scream long-term planning. But here's the big risk, the question you have to ask yourself. Is that FCF target sustainable?
That is the debate the market is still having. Can that cash generation truly hold up as that high-margin linear ad revenue just continues to erode?
We know pay TV penetration is now slipping below 50% of households in the U.S.
And every single lost cable subscriber is a potential loss of affiliate fees and a definite loss of ad revenue.
So the CEO calls it a modern media business, but the market is still discounting the legacy roots.
Precisely. They have a coherent, cash-focused strategy, but the next few quarters will really show if that FCF is structurally sound or if it's just a temporary peak.
Which brings us to our not financial advice segment. We're now shifting into the mindset of a hedge fund analyst, pitching a high conviction, if maybe slightly outrageous trade idea.
And remember, this is purely for entertainment.
Definitely. This is the trade idea that will make our friends jealous and our bosses rich. But before you pitch, let me play devil's advocate.
Please.
You pointed to all that financial discipline, prepaying debt, extending maturities. Isn't it just as plausible that they're doing that because they have to? That it's not strategic discipline, but pure desperation?
That is the critical distinction. But if it were desperation, they'd be selling off assets, not investing in multi-year production on things like the Anne Rice universe. They're doing the opposite. They're de-risking the future. Which brings me to the idea.
Okay, let's hear it.
We go long AMCX. The thesis is that management is cleaning the house for an imminent takeout.
Outrageous, but plausible. Walk us through it. Who would buy them and why now?
The justification is all in the strategic cleanup. Why would a company aggressively prepay debt, extend maturities to 2030, and buy back notes at a discount, while at the same time locking in complex long-term wholesale deals with DirecTV and Amazon?
They're doing all the due diligence and cleanup work for a potential buyer.
Exactly. Yeah. Potential buyer, maybe a larger company looking to scale its streaming wholesale business, or even private equity looking for unique IP with high cash flow.
Yeah.
They don't want to deal with a messy balance sheet or fragmented contracts.
Right.
AMCX has unique, high-quality IP in horror with Shudder, in mystery with Acorn TV, and in genre drama with The Walking Dead and Anne Rice. Management is tidying up the cap structure and the distribution rights before they put the first sales sign up.
So a buyer gets a financially optimized company with a streamlined content engine and a de-risked distribution model. The catalyst here would be continued FCF delivery and more successful launches from that Anne Rice slate.
Proving the new model works. Precisely.
That is a very compelling narrative for a stock that a lot of people have just written off as a structural short. So let's wrap this up. The Q3 report confirmed the great pivot is real. Streaming is winning the domestic revenue mix.
But the downside is the deep operational pain that comes with it. That adjusted EPS miss, that 80% decline, shows just how much profitability is being shed as the linear business decays.
But they do have a coherent cash-focused strategy with that strong $250 million FCF guidance.
They do.
So what does this all mean for you as you look forward from here?
I think the key question you need to explore is whether the market will finally start to price this stock based on its high free cash flow conversion and its new wholesale-focused model. Or will it continue to apply that deep discount based on the structural decline of the legacy business they're so desperately and expensively trying to escape?
The FCF figure is the bridge.
But that bridge has to prove it can carry the entire weight of the company going forward.